All right, everybody, pull up a seat. We're going to roll up our sleeves and get into this one. It's time for our February update. Hi, everybody. I'm Brian Ullman, a financial advisor at Ford Financial Group. And we do these monthly updates to try and check in with everybody to let you know how the investments are doing, how your portfolio is doing, what's going on with broader markets and your retirement plans. This February, we're doing it again. If you like these updates or are interested in seeing more, I'd urge you to like the video, subscribe to our channel, like us on Facebook so you don't miss one of these in the future. So let's dig in. What's going on right now? Well, February has been our second month in a row of pretty difficult returns. There's no secret we've had a difficult start to 2022. January, it's all been about the Federal Reserve, and we covered that a lot in our last update. What's going on with inflation, what's going on with interest rates. Fast forward to February, and here we are at the end of February, and it's been a rough month lately because of what's going on with Russia and Ukraine. If you're watching this, it's no secret at this point that Russia has invaded Ukraine. It's caused some turbulence in markets, and even though the day that Russia invaded Ukraine, markets were actually up. That's probably more on news that it's possible that the Federal Reserve, or this would cause the Federal Reserve to not raise rates quite as quickly. But leading up to this, it's been a heck of a time, and we've had some geopolitical issues. Now, one of the headlines I saw at the end of last month was that the January of this year was the worst month since January of 2009. Which is a bit hyperbolic, I would say, right? Januaries are pretty good, and so it's not a surprise that we haven't had a really bad January in the last decade or so. Also, the notion that we would compare what's going on right now to the near depression we were facing in January 2009 is disingenuous, to say the very least, right? We are in a much different place than where we were a year or 10 years ago even, or more than that, which is to say we are not on the brink of depression. Rather, we are suffering from we are feeling an economy that's overheating, that has inflation, and that's feeling the effects of $6 trillion of stimulus dumped into it over the last year or two. So where does that lead us? Well, how does this relate to Russia even? Well, what's going on in Russia at this point, or what's going on in Ukraine, seems that it's going to be contained in the Ukraine. Now, I know that Russia has gone deeper in the Ukraine and has done more than many people were expecting, even right up until they did it. But the reality is that this, at this point, is a regional issue, or maybe even a European issue more than it is a U.S. issue. And we are invested largely, with the portfolios that we have here, in massive domestic companies that can feel the effects of global events but really aren't hurt too much by them. And so it's important to keep that in mind, that the coffee shop down the street is still going to have a line in front of it tomorrow regardless of what's going on in Ukraine. Cell phone manufacturers, one big one in particular, is still going to be cranking out these phones of theirs that everybody buys all year this year. We're still humming along economically with no signs of recession at this point. So the idea that you'd panic along with everybody else and run the other direction and sell everything you have is a bit of a bad idea. I think we can just leave it at that. What I want to talk about at this point are 5 things that you might want to consider as we are in this rough patch or going through this rough patch, which could last a little bit longer than just 2 months this year. Let's start with the first one here. And the first one is that you want to talk to your advisor about the makeup of your investment portfolio. No, you don't need to know all of the ins and outs. This isn't a test of what your investments are made up of. I mean, you don't drive your car to the mechanic to then go fix it yourself, right? You have them work on it for you. Same thing with your financial advisor. Your financial advisor is working on your portfolio for you, and in our case has the discretion to make these adjustments for you if need be. But it helps to understand what's in your portfolio. When you watch the nightly news and you see that the S&P 500 went down a certain amount, that doesn't correlate one-to-one with your portfolio where the market goes down 5% and your portfolio goes down 5%. In fact, the opposite's true. Many times you have bonds that are baked into the portfolio, and you have a diverse group of stocks that are baked into the portfolio as well that can help even out this roller coaster ride. I'll even do you one better. If you had a retirement plan done by us, we even bake in bad years into your retirement plan. The saying is that we have long summers and short winters when it comes to the stock market and comes to the investments. But still, we have bad stretches, and we're in a bit of a bad stretch right now. Our first meaningful correction since March of 2020 when COVID hit. And thare part of your retirement plan. So your retirement plan isn't totally thrown off just because we've hit a bad stretch. And having some of that context to your investments can really help keep your nerves calm and help you sleep at night as we're going through these difficult stages that we're going through right now. Let's talk about the second important part here, and that's that bonds have been falling. In fact, bonds have had a difficult time. Last year was one of the first years that the bond index had a bad year in some time, and one of 4 or 5 times, I think, ever. And so it's important when people say that they want to get more conservative, they're often saying that they want to get more into bonds, which isn't always necessarily the best move. In fact, the bond index is down 4 or 5% this year, was down a couple percent last year. It's not the conservative move that you think it might be. In fact, diversification is actually the conservative move, and not just diversification among stocks and bonds, but diversification within stocks and bonds, owning different kinds of stocks. Certain kinds of stocks this year aren't actually doing that badly compared to maybe some mega cap tech names. Likewise, these more traditional long-term bonds that many people hold in their portfolios are really not having a great year. But there are other kinds of bonds, other types of bonds that can be in the portfolio that can help act as that stabilizer without the same kind of interest rate risks that come with it. So talk with your advisor about what kind of bonds are in the portfolio, and whether when you say you are wanting to get more conservative, let's actually deconstruct that a little bit. Are you saying that you really do want more bonds, even though they're not doing really great, or are you worried about what's going on with markets, and is the portfolio construction you have really in line with what you're saying to your advisor that you want to do? Let's move on to the third one here, which is to consider the opportunity here. We have dips all the time. We have corrections all the time. I've said this before. We have on average 3-5% dips a year. We have 10% or more dip a year. An average correction is 14%. We haven't even gotten to that average 14% correction in the S&P 500. And so if this dip that we've had to start the year is among these kind of more typical corrections that come after stocks have been high flying for some time, for the right investor, this could present an opportunity where we can get in and have a lower price on a basket of stocks or stock funds or mutual funds than we would have gotten a couple of months ago. And so this can present that opportunity that many times people look back on and wish they had capitalized on. I hear it a lot from 2008 and 9. I hear it a lot from even February and March of 2020. Oh, if I had just gone ahead and done this and overcome my fears, this would have been a good investment. So talk to your advisor about maybe this is a good time for you, depending on your tolerance for risk, to add some more opportunity. Be opportunistic. Add to the stock side of your portfolio to maybe take advantage of this dip. Okay. That was number 3. Now let's take a look at number 4. And number 4 is call for a cup of coffee and a second opinion. Even if you don't have your investments professionally managed, or if they're professionally managed by somebody who you never hear from, it wouldn't be a bad idea to maybe seek a second opinion and see what another professional thinks about the makeup of your portfolio. You have a 401k that's been hanging around somewhere that's not actually being looked at by anybody, and you have an IRA or a trust account somewhere that's supposed to be managed, but you haven't heard from the advisor in a couple of years, and you don't know if anything's been done with it lately. It's probably a time to check in, either with that advisor or with another advisor, and get a second opinion on what's going on with your portfolio. Over the years, your goals change, your investment objectives change, your needs change, and you need to stay on top of that, and that's why you need to stay in touch with your financial advisor. If you haven't been in touch with your financial advisor, it's time to either get back in touch with them or go for a cup of coffee and a second opinion and see what another advisor might think of the makeup of what your portfolio is, what your retirement plan looks like, and what your objectives are. Okay, let's round this out. Number 5 is consider your goals. We get a lot of questions. The market's gone haywire. What should I do about it? And you have to answer a question with a question. Have your goals changed? What's different now from a year ago? Because if we had created a portfolio for what your goals were a year ago and they remain the same, the answer is we probably don't want to do much. If your goals haven't changed, then the makeup of your portfolio shouldn't change just on the whims of the market. Market goes up, and the old saying is stocks take the stairs up and the elevator down. When we get these big whoosh downward drops from stocks and we take the elevator down, I get that it gets unnerving and you start to lose faith in your plan. But you need to stick with your plan, because as we've seen in 2020, in the rebound that it took a matter of months to rebound from where we were from the COVID drop that we had. But go back to 2008, 2000 in the tech wreck, even 1987. it takes months, maybe years, a couple of years. 2008 is a good example. It took about 2 years if you didn't do anything to rebound from where you were. Those rebounds come in your portfolio if you stick with your plan. Whereas if you go running for the exits at the first sign of trouble, you've done a bad job, or your advisor has done a bad job of calculating your tolerance for risk. And you're not going to be around for when that recovery inevitably comes, because it will come. It's especially on a long enough time frame. And so if your goals are 5, 10, 15 years out, boy, now is not the time to change things just because something's gone on in Europe, or the Federal Reserve is raising rates perhaps from next to nothing to slightly above nothing. So keep that in mind, that you want to stick with your plan and make sure that if you're making changes, it's because your goals have changed, not just your nerves have changed because markets have gone down. So I'm going to leave it there. I hope these tips have helped you out. As always, if you have questions about your portfolio with us, or your portfolios anywhere else, or your retirement plan for that matter, email us at info@fordfg.com. My name's Brian Ullman. Stay safe. Hang in there. We'll talk in the next one.